Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into TransMedics Group, Inc., TMDX. This company operates at the critical intersection of life-saving medical technology and high-stakes logistics, and it currently presents one of the most intensely polarized investment stories we have encountered. TMDX is betting its OCS multi-organ platform and 36% projected revenue growth to 605 million will establish a durable moat via its vertically integrated National OCS program, or NOP. They're trying to justify a premium valuation against the existential risk posed by the Scorpion Capital fraud allegations, an accelerating customer exodus, like Vanderbilt, and the 95% cheaper alternative of Normothermic Regional Perfusion.
That thesis statement, it captures the sheer complexity of this perfectly, and it is crucial that you, our listener, understand the tension here. This deep dive isn't just about reading strong financial statements. It requires us to balance proven, explosive financial momentum, that's the bull case, against what you could only call a developing tsunami of regulatory, competitive, and legal risks, all of which are detailed pretty extensively in the source materials we've gone through. We have to analyze not just how they're generating these, stunning profits, but how they built the premium price system that enables that profit, and, well, whether that system is structurally sustainable under what looks like intense government and competitive scrutiny.
Absolutely. So let's start where the market is focused, which is just the sheer momentum. We need to lead with the financials using the most recent data we have for the third quarter of 2025. The company's results, they really paint a clear picture of accelerating market adoption and, frankly, impressive operating efficiency. It suggests their unique tech and integrated service models are gaining traction, despite all the chaos surrounding the stock.
The financials are, from a pure growth perspective, they're undeniable. If you look at that Q3 performance, the top-line revenue hit $143.8 million. This represents a robust 32.2% year-over-year growth. That is a truly significant leap forward in a field like organ transplantation logistics, which has, historically been pretty slow-moving and reliant on older infrastructure.
And their internal confidence is clearly soaring. They didn't just meet expectations, they raised their full-year 2025 revenue guidance significantly. The new range is set at $595 million to $605 million. And if you take the midpoint of that guidance and compare it to their 2024 performance, that translates directly to a projected 36% growth.
Right, 36%.
Think about that for a moment. 36% top-line growth. That is the kind of aggressive acceleration you'd typically associate with, cutting-edge SaaS or pure tech firms, not a company managing medical devices and operating its own private fleet of jets.
But here's where we add that crucial nuance, because growth alone isn't enough. What's absolutely critical to note is the source of that revenue shift. This is the heart of their strategy. The integrated service model, the National OCS program, the NOP, is becoming dominant. In Q3 2024, service revenue comprised 39.4% of the total revenue.
Which shows that fundamental and, I think, deliberate shift away from just selling a device.
Exactly. They're not just selling a large capital expense like the OCS console and disposable kits. They're moving towards selling an entire end-to-end transplant service. And that service includes the device, the specialized clinical perfusion specialists, and that mission-critical logistics network.
And that pivot to a service-heavy model is the engine driving their operating leverage. We've seen really clear operational benefits as they achieve greater scale across their logistics and clinical teams. The second quarter, for example, it showed operating income reaching $37 million on $157.4 million in revenue, which resulted in a very, very strong 23.2% Q2 operating margin.
And that margin was already up significantly from 19% just the quarter before. And this momentum isn't just opportunistic. Management has articulated a clear strategic path for continuous margin improvement. They project substantial expansion for the full year 2025, expecting to deliver at least 750 basis points of operating margin expansion compared to the prior year, 2024.
So to put that in simple terms, that's a 7.5 percentage point improvement in their profitability.
Year over year, which indicates, tremendous success in integrating their NOP platform and just extracting efficiency from their fixed assets. And we're talking primarily the aircraft fleet and the consolidated clinical teams here.
And crucially, this margin story isn't some short-term fix. Their long-term target is ambitious, but honestly, it seems achievable if they continue on this trajectory. They expect operating margins to reach or approach 30% by 2028.
Which is a margin profile that is essentially what happens when you control the entire supply chain and billing structure for a highly regulated, high-value procedure. From the device technology itself to the specialized clinical oversight all the way to the jet that delivers the organ.
And looking ahead, that financial momentum isn't expected to slow down anytime soon. They have multiple new revenue streams already queued up. Management has identified some key future growth catalysts in their pipeline acceleration, moving beyond their currently approved heart, lung, and liver indications.
The big drivers for 2026 and beyond are the revenue-generating pivotal trials for their next-generation devices. That's the OCS Heart Enhance and the DENOVO Lung. And these aren't just, incremental improvements. They represent expanded capabilities and applications.
Right, and we have concrete confirmation on the timeline for those crucial trials, which is important for forecasting 2026 revenue.
Very important. Both the heart and lung trials are confirmed to start enrollment in the fourth quarter of 2025. Their explicit goal is to expedite the process and remove what they call conditional ID caps by early Q1 2026.
And for the listener, an IDE cap, that essentially means the FDA limits the number of institutions or patients that can use the device during the trial phase.
Exactly. So removing those caps is a massive commercial event. It opens the door for a much broader, faster rollout and consequently a much more substantial revenue contribution starting next year. It signifies a transition from R&D expense to immediate revenue generation.
And they are not stopping at the traditional core organs. We also see robust long-term plans for the OCS Kidney program. This targets perhaps the largest volume organ market, and it's aimed at addressing two really deeply entrenched problems in kidney transplantation.
That's right. The two issues they are focusing on are the alarmingly high delayed graft function rates, DGF rates, which currently run between 50 and 55%, and the severely low kidney utilization rate, which sits stubbornly around 60%.
So that DGF rate, that means over half of transplanted kidneys fail to function immediately and require dialysis.
A significant clinical failure and cost burden, absolutely. If the OCS Kidney platform can significantly reduce DGF and improve utilization, that is another massive, virtually untapped market opened up by their technology. It promises a truly multi-organ future.
And that entire vision of explosive multi-organ growth, hitting 30% margins, it relies absolutely on the successful execution of their vertically integrated business model. Which brings us directly to the moat they've constructed, the logistics network.
This is the core competitive differentiation. It's what we call the TransMedics Trident, the advanced OCS device, the specialized clinical perfusion team, and critically, that vertically integrated logistics network, the NOP. They understood that the single biggest constraint in maximizing organ use wasn't the device itself, but getting the organ, the device, and the specialized team to the right place at the right time.
And the logistics network, specifically the aviation strategy, is central to this moat and their premium valuation.
Yeah.
The company has, essentially transitioned into a specialized medical airline. As of October 2025, their logistics network owns and operates 22 aircraft.
And their commitment to this fixed asset base is huge. The financial filings show that transplant aircraft alone represented $281 million in assets as of Q3 2025. And that's separate from their flight school training aircraft.
Right, so owning those assets gives them unmatched control over this mission-critical process of organ transport.
Unmatched. We are talking about highly specialized, time-sensitive cargo. In the third quarter of 2025, their own network covered 78% of all air transport missions required by the NOP. This number is creeping up, too. It was 75% in the fourth quarter of 2024. Management aims to push that coverage into the low to mid-80s for air transport coverage in the near term.
So this integration means less reliance on ad hoc third-party logistics,
which TMDX argues allows them to control safety, training, and most importantly, the reliability that saves organs.
They are now hyper-focused on maximizing the utilization of their existing fleet before committing to more massive capital expenditures. The current operational strategy revolves around what they call the double shift.
The double shift is fascinating. Management is prioritizing, and I'm quoting, efficiently operating our fleet by double shifting a portion of our planes to maximize utilization. This is a very complex operational endeavor in aviation. It means managing pilot and crew fatigue under intense time pressure, accelerating maintenance schedules, and coordinating 2 full flight windows per aircraft in a short period. It's essentially extracting maximum value from their $281 million fixed asset base without having to buy a 23rd or 24th jet immediately.
And they expect early outcomes of this double-shifting pilot program to be visible in the first half of 2026. If that's successful, it proves their ability to scale the service revenue dramatically without immediate new capex.
And that focus on logistics efficiency is already evident in their service revenue growth, which increased a substantial 56% year over year in Q2 2025. This 56% surge is proof that the NOP moat is deepening, and it's deepening rapidly.
And if you look at their long-term goals, you see why investors are so excited about the potential market capture. They have a foundational goal of achieving 10,000 U.S. NOP transplants annually by 2028.
And based on current figures for heart, lung, and liver, that would represent between 50 and 55% of the estimated national volume for those organs. They're aiming to be the dominant integrated player.
Dominant indeed. Management is already setting their eyes on an aspirational target of 20,000 to 30,000 total U.S. transplants by 2030. That level of confidence doesn't just suggest market share capture. It suggests a revolution in the field, increasing overall organ utilization and expanding the pool of viable organs.
And the plan is global. They intend to replicate this vertically integrated NOP model internationally. The strategy includes launching a pilot NOP model in select OUS markets, starting with Italy in the first half of 2026. This is explicitly aimed at stimulating adoption where they see a universal need for a dedicated, reliable transplant logistics network.
Okay, that is the compelling narrative of innovation, execution, and, well, logistical genius. It's the picture of a company transforming a decades-old field. But now we must transition, because this high-flying, premium-price model is under attack. We need to move to the risk side and discuss the allegations that profoundly challenge the foundation of the business practices fueling this rapid growth. The challenge is simple. Does the genius of the logistics justify the alleged cost structure?
Exactly. We have to acknowledge that controlling a private fleet of jets, employing specialized perfusion teams, and delivering organs within tight timeframes is inherently expensive. TMDX built its valuation on justifying that premium cost. But the risk here is that the allegations suggest they move beyond simply justifying the premium to exploiting the cost structure.
And this is where the story truly darkens. We're talking about the claims raised in the short report by Scorpion Capital, which alleged a systematic, anti-competitive scheme that relies on coercion and exploiting the unique, opaque structure of U.S. organ acquisition costs.
The most serious claims revolve around allegations of a Mafia-Style extortion scheme. It involves what the sources call coercive tying. This is critical because if it's true, it means the very core of their business model, the integration, was built on anti-competitive, arguably fraudulent practices rather than pure commercial demand.
Let's unpack that coercive tying mechanism because it's the financial linchpin of the fraud allegations. The mechanism described is that TMDX allegedly denied access to the OCS technology, the life-saving pump, unless hospitals exclusively used its high-cost, mandated NOP services. This bundle included the clinical teams and, most importantly, their aviation.
Think about the power dynamic this creates. Imagine a high-volume transplant center that invested millions in the OCS hardware. Now they need the essential disposable cartridge to run the pump for a patient. Sources allege centers that had already bought OCS systems were suddenly unable to buy the $7,000 disposable cartridges unless they agreed to use the full bundled NOP service, including TMDX's expensive private jet transport.
And the alleged price manipulation makes this tying even more acute and difficult for hospitals to resist. Sources claim that the cost of that critical disposable cartridge spiked dramatically after FDA approval, going from approximately $7,000 to an astounding $60,000 per kit.
So when the cost of the consumable alone suddenly jumps nearly tenfold, it effectively forces transplant centers into reliance on the bundled and allegedly inflated NOP service just to access the device they already own. That's the alleged leverage.
And the financial motive for this alleged inflation is tied directly to the arcane and complex world of Medicare reimbursement for organ acquisition.
Right. Organ acquisition costs, or OAC, cover everything needed to get a donor organ to a recipient center. Retrieval teams, preservation, logistics, the whole thing. TMDX is accused of exploiting a crucial detail. Medicare has historically not put a cap on these logistical expenses.
This alleged lack of a cap is the regulatory weakness they supposedly exploited. Because OACs are passed through to Medicare, the primary concern for surgeons, whose metrics are based on transplant volume and speed, is typically not the price of the logistics. This setup allows a company to inflate charges, and the sources detail specific alleged abuses.
For example, sources claim the system allowed TMDX to inflate charges by flying in multiple non-local private planes for a single organ recovery when local teams could have driven, or when a single chartered flight could have recovered multiple organs using traditional methods. These practices allegedly drove up the invoices by $100,000 to $200,000 per case.
Which creates a perverse incentive.
A very perverse incentive. TMDX maximizes logistics inputs, inflating the Medicare reimbursement, and the transplant center doesn't object because they get the organ quickly and reliably, and the cost is passed on to the taxpayer or Medicare.
This alleged conduct has had severe real-world marketplace consequences. We're talking about a significant customer exodus and widespread disillusionment, especially among the most influential high-volume institutions.
The short report cites the high-profile loss of Vanderbilt's heart program, a significant blow, as Vanderbilt is described as the biggest heart transplant program globally. They reportedly now perform 0 TransMedics procedures because they are so upset due to the cost and the coercive business practices. And crucially, Vanderbilt, recognizing the cost burden, has now switched to that cheaper alternative we'll discuss shortly, Normothermic Regional Perfusion, or NRP.
That high-volume defection is a massive warning sign. Furthermore, other major centers like UCSF and Massachusetts General Hospital, MGH, indicated plans to reduce or eliminate OCS usage due to ridiculous transportation invoices and the cost being simply unsustainable.
There was one executive's quote that captured the raw sentiment of the short report perfectly. He allegedly called the CEO an arrogant prick over the perceived price gouging. That's not a standard commercial disagreement. That's deep, fundamental institutional mistrust.
And this is not just marketplace friction or reputational damage anymore. These allegations have led to serious regulatory heat that moves the risk from reputational to, well, existential. Federal and state investigations are reportedly underway, indicating that the claims are being taken seriously by powerful government bodies.
The level of scrutiny is staggering. The CEO of a major organ procurement organization, an OPO, stated directly that they were interviewed by the Department of Justice, DOJ. And not just them, but the Office of Inspector General, OIG, the IRS, and the Virginia Attorney General.
That signals an incredibly high level of federal scrutiny across multiple agencies, focusing squarely on potential fraud related to Medicare billing and alleged anti-competitive business practices. If these investigations confirm the alleged misuse of the OAC system, the entire financial model underpinning that 36% growth comes into question.
Right. So to transition, let's now look beyond the unconfirmed allegations of coercion and focus on the confirmed and structural threats that challenge TMDX's foundation, both internally and externally, regardless of the outcome of the fraud investigations. And we have to start with internal financial deficiencies they themselves have acknowledged.
Right. We must start with the confirmed internal financial weakness disclosed in their own filings. The company's 10Q filing as of September 30, 2025, disclosed a material weakness in internal control over financial reporting.
And let's drill down into what that means and why it matters in this context. Specifically, they noted that controls over inventory movement within the manufacturing network were not designed and maintained effectively. A material weakness, by definition, means there is a reasonable possibility that a material misstatement of the financial statements will not be prevented or detected on a timely basis.
And while management concluded the financial statements were still materially correct due to additional procedures, which is a necessary disclosure, the fact that they have a confirmed material weakness related to inventory movement is a serious signal.
It's a huge signal, because the heart of the fraud allegation is the pricing and tracking of high-value disposable cartridges and their subsequent logistical charges. A weakness in controlling inventory movement suggests systemic issues in tracking those exact high-value components.
Compounding this is the confirmed legal burden they are already facing, which is directly impacting their operating leverage. Selling, general, and administrative, or SG&A, expenses increased, due in part to higher professional and legal fees. Fees related to an independent review of business practices following the short seller report allegations.
So they're literally spending millions defending the business model that generates their revenue. And those costs directly counter the 750 basis points of margin expansion they are otherwise celebrating.
And that increased legal spend connects directly to the significant securities litigation they're facing. The company is actively defending a securities class action lawsuit. This suit claims, essentially, that management made misstatements that artificially inflated the stock price during the class period by failing to disclose the alleged fraudulent or anti-competitive practices.
The status of that litigation is still pending. Defendants filed a motion to dismiss the amended complaint on October 7, 2025. But this type of litigation adds significant drag, both financially and in terms of management focus. It means investors who were hurt by the sudden drop following the short report are actively trying to claw back losses, creating a long, costly shadow over the company's otherwise impressive growth trajectory.
But perhaps the most enduring long-term threat to the premium valuation isn't the legal battle, which can eventually settle, but the competitive landscape. Transplant surgeons and executives view competitors, particularly the non-device alternatives, as a tsunami due to their comparable clinical outcomes at vastly lower costs.
This is the ultimate structural risk to TMDX's vertical integration model. The company exists because it built a premium product that solved an infrastructure problem. But now, cheaper, highly effective alternatives are emerging that don't require their $281 million fleet of aircraft.
And the primary threat here is Normothermic Regional Perfusion, or NRP. The cost differential is stunning and fundamentally challenges the economics of the entire transplant industry. NRP is the technique of using existing hospital infrastructure, often in collaboration with OPOs, to perfuse organs after death.
The comparison is almost staggering. NRP is highly inexpensive. It costs only about $3,000 for a complex multi-organ case heart, lung, liver, kidney, and pancreas.
So to put that into the perspective of TMDX's model,
that $3,000 is only 3% to 5% of the cost of a standard OCS case, which can easily run $70,000 to $100,000 just for the disposable kit. And that's excluding the rest of the NOP service fees.
when a competitive method is 95% cheaper, the pressure on TMDX's premium pricing model becomes intense, especially under regulatory scrutiny.
And this isn't a future threat, it's an active market disruption. NRP is rapidly taking off in heart and liver segments, and a recent survey indicated that 49 of the 57 U.S. organ procurement organizations already have experience with the technique.
And this brings us back to Vanderbilt.
Exactly. Their highly publicized switch to NRP is not just anecdotal, it is proof that even the world's highest volume, most sophisticated centers are adopting the cost-saving alternative to fight back against the alleged TransMedics pricing. When the cost gap is this huge, it motivates the entire industry to find ways around the expensive solution.
TMDX also faces cheaper competition within the device market itself. Organox, which also uses a form of normothermic pump technology for livers, was recently acquired by Terumo. This acquisition validates the space. It proves there is deep value in normothermic perfusion, but it also highlights a strong, cheaper, and now corporately backed alternative.
And Organox is roughly half the price of the OCS system, but the competition is even more aggressive than that. Sources indicate that OPOs are now moving to offer Organox systems for free to transplant centers within their network.
Free! So think about the implications of that. Why would a transplant center endure the friction, the high costs, and the ridiculous transportation invoices of the NOP system when a comparable technology is offered at zero upfront cost by their local OPO?
This move completely undercuts TransMedics' premium pricing and vertical integration model. And this all ties back to the core clinical criticism of the OCS platform itself. We have to ask, is the technological superiority worth the premium?
Many sources allege that the OCS platform has no clinical value proposition over static cold storage for the majority of organs, meaning it doesn't dramatically improve patient outcomes or viability compared to the decades-old ice cooler method.
This is a devastating critique for a premium technology. The sources argue that the primary driver for OCS usage isn't clinical necessity, but surgeon convenience. Specifically, they cite OCS enabling daytime liver transplant, allowing surgeons to manage their operating room schedules more efficiently and predictably.
So if the primary benefit is operational convenience rather than superior patient health outcomes, the entire premium pricing structure, the one justifying the 36% growth, becomes unstable when a 95% cheaper alternative exists.
That is the ultimate structural vulnerability facing TMDX. If the underlying technology is a commodity, or if the clinical benefit is merely schedule management, the vertical integration moat, which relies on surgeons prioritizing speed and convenience at any cost, is highly susceptible to regulatory intervention that prioritizes cost reduction or competitive pressure from disruptive technologies like NRP.
Now we must synthesize this incredibly complex situation for the listener. For you, trying to build an investment thesis. Is this a high-flying innovator destined to control the organ transplant market for decades? Or is it a high-risk regulatory liability waiting for the inevitable cost correction?
The bull case is clear, quantitative, and potent. Sustained 36% revenue growth validates the vertically integrated NOP business model. This impressive operational execution is driving the aggressive 2030 target of 20,000 to 30,000 transplants, suggesting a massive, untapped market potential in increasing organ utilization across the U.S.
And the company has a proven record as a pioneer. They brought cutting-edge technology and logistical efficiency to a field that desperately needed reform.
However, the bear case argues that this impressive financial edifice is built on a potentially fragile, high-risk foundation. That foundation is compromised by the alleged fraud allegations and the coercive tying model, which may be entirely dismantled by the ongoing securities class action lawsuit and severe federal investigations from the DOJ, OIG, and IRS. If the system is found to be based on inflated Medicare billing through a loophole, the profit mechanism underpinning the premium valuation collapses entirely.
So when assessing the resilience of the company against these headwinds, we have to conclude that the largest structural risk remains cost competitiveness. The looming threat of NRP's 95% cost advantage and the push for cheaper OPO-sponsored alternatives like Organox mean that TMDX's premium pricing model may be completely unsustainable in the long run.
This is especially true if the regulatory and competitive landscape shifts to prioritize lower overall organ acquisition costs and greater transparency, which seems highly likely given the intense government scrutiny. Therefore, investing here requires a very high degree of confidence that TransMedics can maintain its vertical integration moat and its premium pricing structure, even under intense regulatory and competitive pressure, demanding massive cost reduction and greater transparency in billing.
The tension inherent in this business model is the story. Logistical genius and financial engineering have created massive profits, but those gains now clash directly with the ethical and political demands of a heavily regulated, life-saving public health service. The question for you, the listener, is simple. Will the innovation prove powerful enough to justify the premium, or will the inevitable cost correction severely erode that premium valuation?
The market is betting on the former, but the regulatory risks strongly suggest the latter is a high possibility. This is a classic case where operational success and regulatory liability walk hand in hand.
Risk defined, portfolio protected.